If you're keeping up with the news, you've noticed that inflation is at its all-time high in 40 years and that interest rates are starting to hike. But what does this mean? What are the reasons behind this? And how does this impact you as a federal employee? When an economy accelerates a little too fast, we begin to see the return of inflation. We've seen our economy make a significant comeback after the pandemic. The Fed's job is kind of like balancing a plate on a finger. It's incredibly difficult to keep the plate completely still, and any move one direction or the other is going to cause the plate to begin to wobble. The plate resembles the economy, and the Fed's job is really just not to make sure it's not wobbling too much, rather make sure it doesn't fall off and shatter into pieces. And before we get too far, make sure that you look in the description below. We have a link to the article that fleshes out all of these concepts. We try to keep these videos relatively short. The bulk of the information with images and pictures and graphs and all kinds of interesting things are going to be in the article, so make sure that you check out that link below. So what does rising rates really mean, and how does that impact federal employees? There's various things that begin to happen as the economy starts to enter a new cycle. So we're going to talk about some of these today, and we're also going to talk about what you need to be considering in terms of your cash flow, in terms of your portfolio, and how does it apply to the rest of your life. So one of the main factors that is impacted by rising interest rates are fixed income. If you think about it, bonds have a reverse relationship to interest rates, because if you have a bond that's paying 3%, in 3 weeks from now I can get the same bond paying 4%, why would I want your bond? What does that do to the value of your bond? It decreases it, right? And so that's one way that bonds are, or any sort of fixed income, begin to become impacted by rising rates. We also see mortgages go up. So if you are shopping for a house and you're gonna use a mortgage to help pay for some of that portion of the house, you could see the potential for a rising interest rate in your mortgage. Now, it's not a direct correlation. We won't get into how mortgages are actually priced, but just understand that that's something that could happen. So if you haven't refinanced your house and you're above 4 or 5% or so like that, make sure you check out with a lender just to see if there isn't still a rate that's more favorable to you. So what kind of other impact do we begin to see? Well, in stocks, there's also an impact. There are certain stocks that will really suffer during a rising rates environment or an inflationary environment. There are other stocks that historically have done much better and have stood the test of that inflationary period. We're not going to go over exactly all of the different types. Again, if you want more information, check out the article. We go deeper in there. We're trying to keep the video short. But just understand that there's a new cycle that comes into play, and what worked in the last decade may not be the same thing that works in the upcoming decade. This is one of the main reasons that we don't like to refer to bonds as safe. They're different. They're not really safe. They're safe against volatility, but not necessarily against inflation. And so it's a different way of looking at a specific type of investment. And so when you're constructing a portfolio, simply looking at your stocks to bonds allocation, that's just one very simplistic way of looking at a portfolio. Your diversification among each one of those categories has to be much greater than that. So make sure you're keeping this in mind. There's more information in the article. So to give you an example of this, if you have a 30-70 portfolio, 30% stocks, 70% bonds, that may or may not be safer than a 50-50 portfolio. Correlating risk and volatility just to stocks versus bonds is not really a prudent way of addressing what is the real risk to your portfolio and how are you ensuring that you're protecting yourself against volatility in the market, and also, more importantly, aligning your portfolio to your retirement plan. Volatility is a normal part of investing, but you need to understand that risk and volatility are also two different things. Just because something is volatile doesn't make it risky per se, but remember that volatility in the short term is absolutely a risk to you. If you need money in the next 6 to 12 months, and there's the potential for that volatility to make whatever capital you're investing to be lower than what you started with, that's a risk. However, if you're investing in good, strong companies, you have the potential for that volatility to over time become opportunity. One of the most important things you can take away from this is remembering that markets are cyclical in nature. So when you're talking about diversifying your investments, The TSP struggles with diversification because it allows you to invest in 5 core funds, which has some elements of good diversification, but it doesn't really hit all of the different components. Now, there's a mutual fund window coming in, which may or may not be exciting for federal employees. Some of the costs that we've looked at so far seem to be a little bit expensive, but it is certainly an option to be exploring going forward. So we have a graphic that sometimes we use that shows the different modalities of you investing. So you can still create a 60-40 portfolio, but diversifying among various other assets so that you're still maintaining your 60-40 allocation, but you're still much further diversified than just stocks 60%, bonds 40%. So we're going to throw this graphic on the screen here. So we backtested performance on a rising inflation environment, and understand that there are limitations to backtesting a portfolio, but this really just stands to illustrate the point. You see here with a 60-40 portfolio, the adjusted return, the risk-adjusted return rather, that's something called the Sharpe ratio. There is volatility in any type of investment, so you do need to account for that volatility and reduce some of that return. As you continue to diversify and broaden your level of diversification, you may encounter the opportunity to capture some of this greater growth while still allowing some of that volatility to be taken off the table. Now, there is a delicate balance here because, again, the more risk you're taking, the greater the rewards may be, but at the same time, you are subjecting yourself to some volatility. You just have to know that not all aggressive portfolios have the same level of risk. You can have 100% stocks in 2 different portfolios that behave completely differently because the stocks held within, one may be all in the S&P 500, the other may be broadly diversified globally and amongst various different kinds of stocks that provide you with a more well-rounded portfolio than simply just, say, the S&P 500. So we talked very briefly about what happens to fixed income. We know that fixed income is going to suffer, or also known as bonds. And by the way, just a quick note, you should consider your FERS pension as a form of fixed income. Yes, there are cost of living adjustments that come into play, but for the most part, it's a fixed income that comes to you on a regular basis, just like Social Security. So we'll kind of lump that together. Cost of living adjustments, or COLAs, will not keep up and are not really designed to fully keep up with all of the inflation. So we talked about how some of this fixed income begins to get impacted. You start to see a reduction of purchasing power based off the money that you're getting. Also, bonds begin to struggle as well. Lending money becomes more expensive. And on the stock side, we start to notice that growth stocks in particular start to suffer. There are cyclical rotations so that value funds historically have done better. Financials are another component of the market that tends to do better for various reasons under inflationary environments. And so as you reassess your position for the year, think about your timelines. How much money will you need this year? How much money will you need in 6 months to 12 months? And begin to adjust your investment policy. And if you don't know how to do this yourself, this is where you need to work with an advisor. This is not something that you want to simply mess around with or do on the back of a napkin or an Excel spreadsheet. You want to make sure you're creating a very calculated investment policy statement for your portfolio with the goal of aligning your portfolio to your goals, timelines, needs, wants, and desires. One of the most important things in a retirement plan is making sure that you've thought these things ahead of time. There is thought behind your allocation, behind your distribution strategy, behind your taxes, behind your insurance policies, whether FEGLI is still the right policy for you or not, whether you should just drop FEGLI and not have any insurance at all. You could be paying for things and maybe it's not necessary. Maybe you're perfectly capable of self-insuring. These are conversations that you need to be having with your advisors, and realistically, they should be talking to you about what are the changes that are going to happen this year, where are there changes in terms of investments, because we are entering a new cycle. There are real tangible things on which you place value in your life, like maybe spending more time with your grandchildren or sending them to college or traveling more or getting that sailboat, whatever it is. It's very important that you're making sure that your wealth of resources are working as hard as they can be to help you reach those goals. This type of stuff is simple but not easy. It's something that people can conceptualize, but the execution absolutely matters, and the execution is where most people get it wrong. So if you're not confident in doing this yourself, make sure that you're surrounding yourselves with the people that you trust and that you're asking the right questions. This is not something you want to mess up. You kind of really have one shot at making this work. And if you're still working, that is the perfect time to seek a retirement plan. Make sure that you're on track. And if you're not, what are those little things that you need to do to help make sure that you're still going to be on track so your family can retire with financial dignity and independence? So that's all for this video. Remember, there's a link right below in the description that contains a lot more information. I encourage you, click the link. Make sure you're reading the article. We dive much deeper and talk about different concepts in there that we didn't talk about in this video. So make sure you're getting that free resource for you. If you found this helpful, consider subscribing to the channel. We do this stuff for federal employees on a regular basis. We can't possibly take on every federal employee as a client, and so we try to put out as much information as possible so that we're helping federal employees and their families make better financial decisions every day. Be in touch if we can be helpful to you with any questions, because it's not just your money, it's your future.